Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Ryan Huang. And taking a look at Wall Street, we've got a bit of a bounce back. The Nasdaq Composite was up after a soft inflation report eased some concerns about the economy, and that's seen the Nasdaq adding 1.2%. The S&P 500 gained 0.5% to 5,599, and the Dow Jones Industrial Average, bucking the trend somewhat, underwater by 0.2% to 41,351. For more insights, we are joined by Jason Britton. He is the founder and CIO for Reflection Asset Management. Jason, thanks for joining us on the show today. How are you doing?
I'm very well, Ryan. Good morning. How are you?
I'm doing great as well, Jason. Great to have you on. Now, let's get your help first to set a context of what's playing out in the markets these days. And we've been going through quite some choppy times. There was this initial concern about a recession, that risk creeping up. And then now we seem to be getting some risk-on appetite back again. What's going on here?
So it has been quite a roller coaster ride in the States the last couple of days, between the president and his key advisors turning tariffs on and off at the drop of a hat. We've seen swings in the 3 to 5% range broadly in the indices. We've also seen individual names who are susceptible to those tariffs, especially the automakers. And our good friend, the big buddy in chief, Mr. Musk, and Tesla has also had a pretty wild ride. It's interesting, and you did use the dreaded R word. We try really hard not to talk about that in finance, but most major investment houses are now pricing that recession in as a 20% likelihood going into the summer and fall months here in the States.
Yeah, how real is that recession risk? Because we've got indicators in the past few weeks painting a softening of the U.S. economy. To what degree should we be worried about?
So the reality is, I think we just don't know. We haven't seen the full effect of the layoff of federal employees, over 75,000 and counting, being priced in yet into the jobs numbers here in the States. Those numbers all occurred after the last print, which was February 12th as the cutoff date. So most of those happened after that fact. So look very carefully at the next jobs, unemployment numbers coming out of the States. The number today was slightly better than expected as it relates to the cooling down of the economy, but I still think that the Fed is looking for a reason to continue its easing because remember, in the United States, we've got that dual mandate of full employment and 2% inflation as a target. So it's 6-1 and pick 'em, Ryan, as far as the U.S. markets go.
All right, going with the latest inflation data, at least consumer price index numbers, that seems to indicate that there is some room for policymakers to, I suppose, wiggle when it comes to policy. What do you take away from the latest numbers where we've got a CPI up 0.2% on the month, which puts the annual inflation rate at 2.8%. That is lower than the consensus forecast of 0.3% and 2.9%.
So it was lower, and we actually saw a favorable revision down in the last jobs reports as well. So what the traders are pricing in right now is roughly a 50% chance that the Fed is going to, drop interest rates 25 basis points at the next meeting, and is looking at probably a 66% chance or slightly better than that at a full 70 basis point cut for 2025. So I think that some folks are taking solace in the idea that the Federal Reserve lowering interest rates will take the sting out of some of the tariffs. It'll still be industry specific. And again, we'll see what happens when things actually get implemented or not. We did see that the U.S. House just passed a budget resolution to continue funding the federal government through September. Still has to work its way through the Senate. So right now for international investors, I would say the U.S. is the Wild West again.
Yeah, so we've got the March FOMC meeting coming up next week, and of course more meetings to come. What is the play here for interest rates? Are we looking at still 3 on the table or less?
I still think the market's pricing in 3, but I think it's pricing in at the March meeting, a stay as steady as she goes. They're not going to move it one way or the other, and that they'll see that first 25 basis point drop at the June meeting.
Okay, so that's something to look out for. So when you look at what we should be doing in terms of allocating your portfolio to various sectors, what should we be leaning towards and what should we be reducing exposure from?
So I think in the United States, you have to play it cautious and you have to be under allocated to some of the volatility that is in the technology space. I know the Magnificent Seven and those names have really been driving things, and there was just a TMSC potential joint venture announcement recently, but I still think there's more risk to the downside in that sector. I think in the U.S. side of things, you're going to look at things like healthcare, utilities, and defensives, those names that will likely not be affected much by the tariffs and will do well in a strengthening or at least a stagnating U.S. economy.
Now, talking about a stagnating U.S. economy, we've been hearing a lot about the consumer sentiment, the spending sentiment at least starting to soften. Is that starting to be a concern to you as well?
Absolutely. So the end-all, be-all in the United States economy is the consumer. It's close to 70% of total expenditure. As goes the U.S. consumer, so goes the U.S. economy. So as soon as that confidence starts to shift to the negative and you see that sentiment really dragging, you'll see American households tighten their spending and you'll see that reverberate its way through the economy. It is the number one driver. Regardless of what you see headline risk in the economy and so on and so forth, the consumer really is the number to watch.
Yeah, just looking at the latest earnings season, we had Walmart in the picture where they painted a rather cautious outlook for what's to come, partly because of tariffs, partly because of the softening U.S. consumer sentiment. What were your takeaways from the recent earnings season?
So I think that you have a tale of two stories there, right? So part of it is them trying to give the market a little breathing room as it relates to the tariffs and the potential volatility that comes from some of the government programs and some of the slashing. I mean, you see across the board, both universities and also in the pharma and biotech industries, grants and things from NIH being rescinded left and right from DOGE cuts. So I think they're taking advantage of the headlines to try to shield things towards the downward side so as not to make the market overly depressed. But I also think that there is, remember, we are still coming off of some really strong years post-COVID where growth was extraordinary. And on a year-over-year basis, that's something that always gets compared to. So any chance you have as corporate CEO to manage guidance down and use the expectation of some externality that's not your fault or not your company's doing, but is external, like government changes, et cetera, you're going to take advantage of that wherever you can.
All right, we've been in conversation with Jason Britton. He is the founder and CIO of Reflection Asset Management. Jason, great having you on. Thanks for the time and insights.
Always a pleasure, Ryan. Thank you so much.
All right, catch up again soon, Jason. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.